Welcome to the deep dive. We're here to cut through the noise and really get you up to speed on the big shifts happening around us. Today, we're jumping into something huge in finance, something that's really gathering steam fast. Get this. Real-world asset tokenization, or RWA. Well, after people thought the whole idea was pretty much dead in the water, it suddenly shot up from maybe $5 billion to $24 billion in just 2 years. That's quite a comeback. So, okay, let's unpack this a bit. What exactly are real-world assets when we talk about crypto, and why the sudden buzz again after, those earlier stumbles?
Yeah, it's a great place to start. Basically, RWA tokenization is about taking real stuff, things you can touch, like buildings or gold, or even intangible things like patents or, believe it or not, coffee trees, and turning their value or ownership into digital tokens. These tokens can then be traded, bought, sold, all on a blockchain.
Okay, so like digitizing ownership of physical things.
Yeah, exactly. Think of it as finally building that bridge, between all the value locked up in the real world and this new digital finance universe. But it's more than just fancy tech talk. It's about unlocking potentially trillions in value that's just sitting there, illiquid, and changing who gets a piece of the pie. So in this deep dive, we'll break down not just the what, but the why. Why it's working now, what went wrong before, and how platforms like Avalanche are becoming so central to this whole movement.
Right, that context is key. So we get the what, but why now? What's the big pull? What benefits are really driving these big institutions and the innovators to jump in?
Well, the main driver is the potential for just much better market efficiency and opportunities that traditional finance, TradFi, often struggles with. A huge one is accessibility, democratization. Think about those super high-value assets, luxury real estate, private equity funds.
Yeah, stuff most people can't even dream of investing in.
Exactly. Usually only for accredited investors, right? Big money. But tokenization lets you do fractional ownership. It's like dividing a huge cake into smaller slices so more people can actually have some. Makes these assets available to way more investors.
Okay, fractional ownership, wider access, and I guess that ties into liquidity too, making things easier to trade.
Absolutely critical. That's probably the second biggest thing. Assets that are traditionally really hard to sell quickly, like a building or a unique piece of art, they become much easier to trade when they're represented by tokens on a secondary market. They become liquid.
Right, turns a locked-up asset into something you can actually move.
Precisely. And then there's the cost-saving and efficiency side. Think about traditional finance. All the paperwork, the middlemen, the fees, the delays. Blockchain and smart contracts can automate a ton of that.
Yeah.
Cutting out intermediaries, streamlining processes. The IMF, the International Monetary Fund, actually pointed out significant cost savings in DeFi, decentralized finance, because you don't have all those high labor and operational costs you see in TradFi's complex systems.
So less friction, faster, cheaper. That sounds like a pretty potent mix for finance.
It really is. And one more key piece, transparency and verifiability. With tokenized assets, everything's on the blockchain. Ownership, transactions all recorded publicly, immutably, anyone can audit it.
Which is a big change from relying on, trusted third parties and opaque records.
Huge change. And if you connect this to the bigger picture, RWAs bring stable, reliable yields into DeFi, yields backed by actual traditional assets. This bridge is vital if DeFi wants to tap into that massive pool of value in TradFi. We're talking like over $600 trillion globally in traditional assets compared to maybe $1 trillion, give or take, in digital assets currently. It's just a massive opportunity.
Wow, $600 trillion versus $1 trillion. That really puts it in perspective. Okay, but like we said, this isn't totally new. The RWA idea nearly died, as you put it. I remember hearing about some projects a few years back. It sounded amazing, but then they just fizzled. What actually went wrong then? How did things change?
You're absolutely right. It was a tough beginning. Around, say, 2018 to 2021, lots of projects launched with big ambitions, but they couldn't get traction, couldn't get trading volume or real adoption. They were maybe ahead of their time, yes, but they also fundamentally lack some critical pieces.
Can you give us a specific example, like what was a poster child for those early struggles?
Sure. A well-known one was the St. Regis Aspen Resort tokenization back in 2018. They actually sold $18 million in tokens representing ownership.
Okay, sounds successful initially.
It did, but by 2020, the trading volume, the liquidity, had just dried up. A core problem was how it was structured. Token holders didn't own a piece of the hotel directly. They owned shares in like an intermediary company. This created confusion about rights, added extra fees. It wasn't the clean, direct ownership people envisioned.
So it added complexity instead of removing it. Not ideal.
Not at all. Another one was Harbor. They tried to tokenize $20 million in student housing. They even got regulatory approvals, which was a big step then. But the deal fell apart because a traditional lender involved in the property's mortgage blocked it, cited legal conflicts. The existing financial and legal systems just weren't ready.
Okay, so if we sum up those early attempts, what were the main roadblocks? What's the big takeaway?
Yeah, looking back, it really boiled down to about three core things. First, legal systems didn't really recognize tokenized ownership or title. The laws just hadn't caught up.
Makes sense. Legal uncertainty is a killer.
Definitely. Second, the investor pools were tiny, often restricted just to accredited investors, and even then with high minimum investments like $10,000 or more. That killed the whole democratization idea right there.
Right. Didn't actually open it up much.
And third, critically, there was no real market infrastructure. No market makers providing liquidity, no robust secondary markets. You could buy the token, maybe, but selling it was tough. So the big insight wasn't that the core idea was bad, it was that the foundation wasn't there. They tried to build the fancy car before the roads or the traffic laws existed. That's what's different now.
Building the car before the roads. I like that analogy. Okay, so if infrastructure was the missing piece, what changed? Why now? And specifically, why is a platform like Avalanche getting so much attention? Consistently ranked like TOP1 in RWA. Why are big institutions choosing them?
Right. Well, Avalanche really focused on building solutions that directly address those earlier failures and, crucially, cater to what institutions actually need. It's about providing that robust, flexible, secure foundation that was missing.
And that starts with customization. I keep hearing about Avalanche L1s. They used to be called subnets, right? What makes those so attractive for big players?
Exactly. L1s are key. Think of them as independent, custom-built blockchains running within the Avalanche ecosystem. Enterprises can use these to create blockchain environments perfectly suited to their specific requirements. They can set their own rules for transaction fees, maybe even pay in their own token, not just AVX. They can decide who validates transactions, what kind of performance they need. Public chain. Private permission chain. They choose.
Okay, so total control over their own little blockchain world, essentially.
Pretty much. Sovereignty over their block space. That lets them manage costs, control governance, ensure compliance, all without interfering with or being impacted by the main public network. Huge for regulated businesses. And beyond just customization, there's speed and scale. Avalanche's architecture allows for, well, theoretically near infinite scalability, lots of transactions per second, and importantly, very fast finality. Sub-second finality, they call it.
Sub-second finality, meaning the transaction is confirmed and irreversible almost instantly.
That's the idea. For high-value institutional trades, even a tiny delay or uncertainty about whether a transaction might be reversed, that can mean millions in losses. So near-instant, guaranteed settlement is massive.
Yeah, I can see why that would be critical. And how do these custom L1s talk to each other?
That's where something called warp messaging comes in. It allows seamless communication and asset transfers between these different L1s, vital for building complex, interconnected financial applications. Plus, institutions can bring their own trusted validators onto their L1. This creates these enterprise-aligned validator sets, which provides that rock-solid finality without reversals. It removes settlement risk, a major worry in traditional finance.
And you mentioned privacy or experimentation, too.
Right. They have evergreen subnets, now evergreen L1s, I suppose. These are specific permissioned environments built for financial institutions, places where they can test out tokenization, build applications, without any exposure to the public chain until they're ready. Addresses big concerns around privacy and control.
Okay, it sounds like a comprehensive toolkit for institutions, and the list of names using it is pretty telling.
It really is. You've got Amazon AWS, JP Morgan, Citi, Deloitte, UBS, MasterCard, Visa, BlackRock. These aren't small pilot projects anymore. It signals a much deeper shift. These players are seriously exploring, building, integrating. It suggests they see a future where finance operates natively on-chain.
All right, let's make this even more concrete. We've talked theory, we've talked platforms. What kinds of actual real-world things are being tokenized right now? Any cool examples, especially on Avalanche?
Oh, definitely. The range is already pretty broad. You have the basics, the foundation, which are fiat-backed stablecoins, things like USDT, USDC, DAI. They are technically the original and still the biggest RWA category. They make up like 95% of the stablecoin market. They're the bedrock for a lot of the crypto economy.
Right, tokenized dollars, essentially. What else? Commodities?
Yep, commodity-backed tokens are growing. Tokenized gold is quite established. Tether gold, PX gold are examples. People are even tokenizing things like uranium.
Uranium. Okay, that's niche.
Huh, yeah, definitely niche. But then you have tokenized US Treasuries. That market just exploded, grew something like 782% in 2023 alone. Big names like Franklin Templeton, Ondo Finance are bringing traditional fixed income products onto the blockchain, attracting serious institutional money.
Wow, 782% growth. That's significant. What about physical assets like real estate or vehicles?
Huge potential there. And some really interesting projects are happening. Take Toyota Blockchain Lab. They partnered with Avalanche. They're building this thing called the Mobility Orchestration Network, MON. It's basically a blockchain network for future robotaxi services.
Robotaxis on the blockchain, how does that work?
They're essentially turning vehicles into unique investable digital assets. Using NFTs, they call them trust chains, to represent each vehicle's identity and history. This could enable all sorts of cool things, like much easier cross-border leasing, fractional ownership of vehicles used in ride-sharing. Really innovative stuff.
Turning cars into tradable digital assets.
Yeah.
Wild. And real estate construction.
Yeah, check out TRIZ in Montreal. They're using an Avalanche L1 called ResiNet to finance a massive $300 million housing project, like 960 units, and they have a $2 billion pipeline. They're tackling a real-world housing shortage by using tokenization to access new funding sources.
That's impact. And government's getting involved too.
Definitely. Look at Dubai. Their land department is launching something called Pripco Mint next year, May 2025. It's direct property tokenization, and the ownership transfers will be synced directly with official government land records. They project it could be a $16 billion market by 2033 just in Dubai.
Government integration. That's a major step for legitimacy. What about smaller, high-value items?
Good question. Luxury goods, collectibles. Big market for fakes there.
They should probably.
So there's Calachain, another Avalanche L1 project. It's focused specifically on verifying and authenticating high-value goods, think luxury watches, rare art, collectibles, fighting that multi-billion-dollar counterfeit industry using blockchain transparency.
Makes perfect sense. And big finance testing the waters.
Absolutely. Wellington Management, they manage over $1 trillion. They're running trials in Spruce, one of those Avalanche evergreen environments. They're working with Citi and Wisdom Tree, testing things like executing trades on-chain, settling foreign exchange transactions, handling interest rate swaps using tokenized assets, real institutional plumbing being built.
And beyond finance, you mentioned coffee trees.
Yeah, that was Project Mocha. It's actually on a different chain scroll, but it's a great example of impact tokenization. They tokenize individual coffee trees in Kenya. The idea is to directly fund the farmers who care for those trees. So all these examples, they really show how tokenization isn't just hype. It's enabling totally new business models, new investment opportunities, things that were just impossible or way too inefficient before. It's extending finance in really creative, sometimes impactful ways.
It really highlights how much of the old financial world is kind of clunky, dealing with issues that blockchain seems purpose-built to solve. Okay, so looking ahead, we've come a long way, clearly. But what hurdles are still out there, especially regulations, security? What needs to happen next?
Yeah, despite all the progress, there are definitely still significant challenges. Number one is probably navigating the legal and regulatory landscape. It's messy, compliance is complex, different regions, different rules that are still changing, figuring out if a specific token is legally a security or something else. It's a legal maze, as some call it.
And doing this across borders must be a nightmare.
Oh, absolutely. Cross-border tokenization faces huge hurdles.
Yeah.
Different jurisdictions have different views. Tax implications are often unclear. It's a major headache if you want to operate globally.
Sounds like the lawyers have a lot of work to do catching up to the tech.
They certainly do. But interestingly, the technology itself can actually help solve some of these problems. Think about automated compliance. You can build systems that automatically check transactions against, say, anti-money laundering rules or know your customer requirements, reduces human error, speeds things up.
Using tech to enforce the rules.
Exactly. And smart contracts are key here, too, for legal assurance. You can program them to automatically enforce the terms of an agreement. For instance, a smart contract could physically prevent a token from being transferred unless the recipient has passed the required KYC checks. It's like having compliance checks baked right into the code itself.
Like a digital lawyer enforcing the contract automatically.
Kind of, yeah. So getting broader buy-in from the big financial institutions is still ongoing. It requires continued transparency from the blockchain side, showing those real tangible benefits, faster settlement, lower fees, and lots of collaboration. Which brings up a key question. Can these platforms like Avalanche, with their L1s offering this mix of privacy options and interoperability, this hybrid operational intelligence, can they truly satisfy what institutions need while still giving them the benefits of decentralization? It's not a one-size-fits-all answer. It requires tailored, secure solutions.
It feels like the tech is definitely racing to meet those institutional demands. And even with that incredible growth to $24 billion, it's still tiny compared to global
Well,
wealth.
it's less than 0.01%.
Vanishingly small, yeah.
Yeah.
Which is why the predictions are so bullish. Some see a $4 trillion market for tokenized assets by 2030. We've barely scratched the surface of what's possible here. Wow. Well, this has been an incredible deep dive into RWA tokenization. We've really traced its path from, a struggling idea to this surging market. And it's clear platforms like Avalanche are playing a huge role in enabling these institutions and these really groundbreaking uses.
The writing's kind of on the wall, isn't it? The competitive pressure is mounting. Financial institutions that ignore tokenization, they really risk seeing their traditional assets and services become less relevant, maybe even obsolete over time. The future of finance just looks increasingly like it will be natively on-chain, value moving faster, smoother, more efficiently.
It certainly feels that way. And that leaves us with a final thought for you, our listener, to chew on. Given how fast this is moving and its power to reshape finance, what things in your daily life, or maybe in your industry, what assets do you think might be tokenized next, and how could that actually change how you interact with them or how your sector of the economy works? Something to think about.